Hi, I'm Sandra Burris with Keller Williams Realty. Today we're talking to Greg Park, owner of American Mortgage Company. Thank you so much for joining us, Greg. Tell us a little bit about American Mortgage Company.
I'm glad to be here, number one. And American Mortgage Company is a broker shop that I started back in 1999. I've been in the business since 1992, and we've been the in-house lender here with Keller Williams Allen since 2009. So been in the business a long time, seen a lot of markets, seen a lot of shifts, and happy to be here today.
Great. Well, considering we're talking about a bit of a shift, I've been hearing a lot about, obviously, interest rates have increased.
Yep.
And I'm hearing about people wanting to get information about buying down their rate. Can you tell us a little bit about that, and how would somebody evaluate if that's a good thing for them to do?
Absolutely. Yeah, number one, you need to have a good loan officer that's experienced and understands the market and how these buy downs work. But typically, there are buy down options that will buy that interest rate down permanently for the life of that loan. And it's just a matter of determining, is the cost of buying it down worth the monthly savings? In this situation, and the average family stays in their house about 4.5 years before they upsize, downsize, relocate, whatever the case may be. So with that information, we can determine the cost to buy that rate down, divide that by the monthly savings that we create, and see how many months it takes to recapture that upfront cost. And if it's less than 5 years, yeah, it may be worth it to buy that rate down. If it's more than 5 years, then we've got to determine, are you going to be there long enough to recapture that cost? Absolutely. And that's something, those are numbers we can crunch when you call in. It takes us 60 seconds to crunch those numbers for you. That's data that's really easy to calculate.
So how much does it reduce your monthly cost, and how do you calculate that when you're looking at the buying down 0.25% or whatever, a point? What is that?
So the savings differs based on credit score and current market conditions, because that dictates the interest rates. And loan amount obviously has an impact. So when we were crunching the data earlier in the week, on a $350,000 loan amount, for every 0.5 point difference in rate, that changes your monthly payment by about $90. For a full point, it'd be a $180 difference.
Got it.
If we want to bump up to a $400,000 loan amount, then for a full point difference, it's $210 a month, or half of that for a 0.5 point difference in rate. Now, the cost to buy that rate down, rates are in increments of 1/8 of a point. So it's not a linear cost. So every eighth costs X amount. The lower you go in that interest rate, the more expensive it becomes. So not linear, it's exponential. So at some point, it's not cost effective to buy that, to continue to buy that rate down lower and lower. And that's where the calculation comes into play. The cost to buy this rate down a 0.5 point may be $5,000. The cost to buy it down a full point may be $15,000. At that point, it's probably not cost effective to do it based on the monthly savings.
Right, got it. What about the difference in them thinking about buying down the rate or putting additional money down as a down payment? If they've got additional cash, is it the same kind of equation that you look at?
Yeah, so in that situation, yes, it can be. For every $10,000 difference in loan amount, it makes about a $55 difference in monthly payment. So that's pretty linear. Where it can differ is with the interest rate. Again, credit score and market conditions can dictate the cost of the rate. So today's rate to get 4%, the cost to get it may be different than tomorrow's, which may be different than next week's. Again, market environment, market condition dictates interest rate pricing. But the $10,000 up or down in loan amount stays fairly consistent. It'll vary a little bit based on rate, but not tremendously, unlike the cost to buy the rate down.
So with the adjustment in the market, what are you seeing coming in contracts that you're reviewing and things like that? What kind of things are you seeing?
What we're seeing is we're going through another shift back to a more traditional real estate market. Probably for the past year and a half, maybe even 2 years, with the low rates and the low inventory on the market, we were seeing a lot of buyers offering seller concessions, as opposed to the opposite, which is a more traditional market. So very unusual, unlike anything I've seen in my 30 years. So you had a lot of buyers offering to pay owner's title policy and offering other concessions to the sellers to get that contract for
Right.
that property. Now, more inventory is coming online. Interest rates are a little bit higher. The market is shifting back into a more traditional real estate environment.
Okay.
So we're seeing seller concessions coming back online. We're no longer seeing buyers offering to pay owner's title policy and other items. So the buyer can now take those funds that maybe a year ago they were having offered the seller and taking that and maybe buying that rate down permanently.
Oh, okay.
And seller concessions, same thing. If we've got seller concessions in that contract, use those funds to buy that rate down permanently. So that's a more traditional market, and that's what we're seeing coming back.
Okay. This was such helpful information. And if anybody wants to contact you, can they reach out to you directly?
Oh, absolutely. They can call my cell number, 972-897-6348, 7 days a week, up to 8 p.m. every day, or email me,
Awesome.
greg@amortgagecompany.com.
Wonderful. Thanks so much. And I hope this information was helpful to you. And as always, like, comment, and subscribe, and share this video with anybody that you think might find it helpful. Thanks so much.
Have a great day.